afternoon, everyone. I'm excited to be here today to introduce our webinar, Sustainability Assurance, Requirements, Audit Steps, and Preparation. Today's webinar will cover a short introduction to SGS, 4 reporting regulations for North America, who is affected and what disclosures are required, 2 pathways, training, risk assessment, and reporting for EU CSRD and California climate rules, a demo of Gravity's reporting platform and audit-ready data. We'll then continue the 2 pathways, pre-assurance and assurance, and we'll end the presentation with Q&A. Please feel free to use the Q&A box at the bottom of your screen throughout the presentation to submit questions. We will be distributing the slide deck, the recording, and the links to the training to all attendees at the end of the presentation. My name is Kim Lefrancois, and I am the ESG and Sustainability Business Development Manager for North America here at SGS. I've been in the testing, inspection, and certification industry for nearly 10 years, working with many different clients throughout various industries. The other speakers joining me today are Adam Hammis and Jay Ruckelshaus. Adam is the ESG Director at SGS and has 20 years of experience as corporate ESG sustainability consultant, author, and instructor. Adam has founded multiple organizations and has an MBA with international education and leadership experience integrating ESG, CSR, and sustainability into corporate strategy. He has also taken many different courses to become a competent and effective resource for ESG and sustainability. Jay is the co-founder and head of partnerships and policy at Gravity. Gravity is a carbon and energy management platform that aligns sustainability and business value. Jay leads Gravity's climate strategy and partnership, helping businesses define and achieve their climate objectives. Previously, Jay worked in academia and economic development, publishing in leading academic journals and major news outlets. We're in great hands today. I'll now pass it over to Adam so we can dive right in.
Thank you, Kim, and thanks to everybody for being here today. I know it's busy. I'll jump in and just say you might have heard of SGS. I'll go through this kind of quickly, but we have been in business for over 140 years. We're the largest and leading in the TIC industry, testing, inspection, and certification. We have sustainability embedded in the company and have been for quite some time, from the board and CEO all the way down to our people in the field. We've been doing this for quite some time. I said we sit on most of the working groups globally when new standards are being worked on and need to be verified and assured. We're always participating, and we get recognized by many of the same organizations that you do as our clients because we are large, publicly traded, and global. And so Time recently named us one of the most sustainable companies in the world, best in the TIC industry, but EcoVadis, DJSI, ISS, MSCI, Sustainalytics, CDP, we're doing the same work, and so we understand the reporting requirements out there. Talking about North America, and it's obviously, if you're international and multinational, you're going to hit some other things. So we'll talk about what's really driving things in sustainability reporting. Today in the US, it's really about California SB 253 and 261, the climate rules that has, survived the last cycle of elections, and it is holding strong. Although you know that the SEC ruling has gone away, there was a federal supplier rule that went away. A lot of the rules that were ready to take effect clearly have not or will not take effect. However, what typically happens when federal goes one way, states respond, and Colorado, Illinois, New Jersey, New York, and Washington have also proposed additional and similar legislation, just like California, and there's probably more coming. And so we don't expect that to go anywhere, although, keep your eyes open. To keep it really confusing, California now is embedding this in the health and safety codes. So there will be new numbers, 38532 and 38533, but it is essentially the California climate rules. There are larger things at play. European Union, and these are still some that are mandatory, is CSRD, or the Corporate Sustainability Reporting Directive, for publicly traded and large companies. They're using a double materiality assessment threshold, which we'll talk about. China has their own sustainability reporting standards called CSDS, which uses a double materiality threshold, and Canada is not mandatory. The soonest it would become mandatory is 2028. That's in line with IFRS, which is internationally around the world. Jurisdictions are adopting this because IFRS is the global standard, except for the United States, who still uses GAAP accounting, that they have the S1 and S2 sustainability standards, which is only financial materiality, which we'll talk about in a little bit. But to add confusion, it's also called CSDS. So those are the things that I would keep an eye on. They're really driving sustainability reporting. And in the US, it's really narrowly focused right now on climate and greenhouse gas emissions. But then if you look at those large publicly traded companies and or just large enough to meet the threshold for some of these regulations, they are pushing pressure, which you might also feel on the small and medium-sized company if you're in the supply chain for one of those companies. And that's because internationally, there are these supply chain and sustainability ratings that are driving business, and large companies trying to manage their supply chain and get transparency, traceability, and see how companies are performing on sustainability within their supply chain. So you'll also feel that in the form typically of surveys, CDP and EcoVadis. I think EcoVadis I would point to just as a large and growing kind of hockey stick growth. So those might be the ones that you've heard of. None of that matters unless it applies to you. So I think the overarching message will always be find out what is relevant to your company and what is material to your business. And so what is your organization's number one business driver for climate risk reporting or sustainability reporting? If you wanted California, CSDS, which is in Canada, EU, CSRD, or is it just you expect increasing regulation, or is there some other program that you're a part of? And so I would tell you that we here in SGS are subject to all of the above. We are global, international. We're in boots on the ground around the world. My team works in Canada and the United States. We're both CSDS and California SB 253 and 261. But what really matters is for your business. And so take a moment, decide which one is right for you. And I'll give you a few minutes while people are still submitting. But just really consider that this term, which we're going to talk about next, of materiality, is how you can slice through the confusion and the alphabet soup, sometimes people say, of sustainability. Is you have to figure out which ones apply and which ones don't, and ignore what is not going to be relevant. Keep an eye on it for the future, but you've got to really focus, because some of these have small idiosyncrasies and you just want to be able to meet the compliance requirements, especially if you're going to report. You don't want to go through a whole reporting process, do all the work, put in the time and effort and the money, and then find out you complied with the wrong one and it was a slightly different standard. There is better alignment over time, I will say that, which we'll talk about next as well. But I'm going to just pause. I think it's slowing down. So here we go. California is a leading one. It doesn't surprise me. It's really front and center, and some deadlines coming up. But there's a balance. If you have an other and you want to throw that in there, look at the Q&A box. Go ahead, and that could be a chance to test it out. Go ahead and share with us what that other might be that is the driver for you. But let's talk about some of this alignment. And this is only in the last 4 to 5 years. So alignment of standards, and we drew a nice little orange line. If you want to follow some of these, it kind of shows you where the confusion comes from. But I promise you there is growing alignment. There used to be the Integrated Reporting Foundation standards, SASB, the Sustainability Accounting Standards Board, standards, TCFD, the Task Force for Climate-Related Financial Disclosures. They all combined under the Value Reporting Foundation, and then that was absorbed into IFRS, like I said, the International Financial Reporting Standards Foundation, which is for the entire globe, except for the United States. And they have then since released S1 and S2. So if you really want a shortcut, go to S1 and S2 of IFRS. Some people call it ISSB. That's the subcommittee that created it for more confusion. But just go look up IFRS, S1 and S2, and it's a culmination of integrated reporting, SASB standards, TCFD, and the SASB standards still sort of exist on their own and are being updated. But Canada, as an example, is a local North American version of their adopting their own jurisdiction of IFRS S1 and S2. They're calling it the CSDS, but it is based on IFRS, and that's the entire world is in the process of doing. Everything above that dotted line is an investor-driven, single financial materiality approach, where everything below the line, GRI, the United Nations Sustainable Development Goals, and then CSRD in China are good examples of double materiality, which I'll talk about here in a second. But that just means that you're talking about above the line, which we'll do California first and talk about that, is financial materiality. It's not what your company is having an impact on society and the planet. It's not the feel-good sustainability stuff. It's which ecological or social issues are impacting your bottom line as a company. And that's why investors are interested in it. There is a short, medium, and long-term threshold to look at, which encourage you to think beyond maybe what you've typically thought about, but it is a single materiality financial impact to your business approach. And if you look at it, that's where California lines up. I'm just throwing this in here. You will be able to download when we send you all these slides. These are just clickable links that you can go read the TCFD, read about the California law, read about IFRS specifically, or read about Canadians' version of IFRS specifically. But Canada, just to be clear, Canada and the California climate rules align with TCFD and single financial materiality approaches to regulation and disclosure. So what does that look like? If we want to dissect California, it's two separate rules that are very much related. 253 is for bigger companies. 261 is for slightly smaller companies, but still large. So across the top, 253 is companies that make or that made in the previous year $1 billion in revenue overall and did business in California. So it's not made $1 billion of revenue in California. It's two separate things. It's both did businesses in California and made $1 billion. The $500 million threshold is for smaller companies, and that's SB 261. The difference is if we start at the bottom, if you're a $500 million company, but not quite a $1 billion company in revenue, you only have to do a climate financial risk report, and that's in line with TCFD and IFRS. S2, which is specifically the climate standard. The report has to be published online somewhere publicly on your website and then submitted to the portal. That portal opens on December 1st, and then you have to submit your link to the portal by January 1st of 2026, which is why people are interested right now. That is a biannual, so every 2 years you have to re-up and renew that climate risk report for the foreseeable future. That's SB 261. That applies to about 10,000 plus companies right now. And there is a violation. The max penalty is $500,000 per year if you don't meet the reporting standard. Now, if you're larger and you make $1 billion, you're going to have to start reporting. And this is due by June 30th of next year to report previous financial year data to the best of your ability. Scope 1 and 2 GHG emissions, which is your owned emissions or your purchased electricity or steam, things like that. You're going to still report that to CARB, which is the California Air Resources Board, and you are required to have a limited assurance, third-party assurance of that data for Scope 1 and Scope 2 only. The next year, you'll have to add Scope 3 emissions with no assurance. And then as you go by 2030, they are going to have you bump up to reasonable assurance, which is an investor level grade third-party assurance for Scope 1 and 2 emissions, and then limited assurance for Scope 3, which if you're familiar with Scope 3 is much harder to get primary data for because it's your upstream and downstream supply chain. So that's a bunch of information. 253, which is the $1 billion companies, that's about 5,300 companies. And all of this is now, the deadlines have been released. They do continue. If you follow CARB, you can go put your email in and get updates from them regularly about any additional guidance and things like that. I wanted to jump down because there was a question. Connor says 253, our fiscal year does not follow the traditional calendar year, and I haven't seen clarification in recent webinars on how the cutoff applies for non-traditional fiscal years. Could you advise whether companies in this position can use fiscal year 24 data, given the extremely tight turnaround to compile all of your complete calculations would be very helpful. That's a great question, Connor. And I'll also, if Jay wants to chime in, typically they're going to want previous year, and they want your best good faith effort to have previous year's data. And that is the expectation, but there is this good faith clause in the regulation. And if you can only use 20, say if you have a very untraditional or non-traditional that you just will not have the data in time, they will accept. And some people are, again, there's not a very crystal clear clarification, but they said good faith effort to have the most accurate and most timely data, which is the previous fiscal year. So if you can't just use, you might, and you should be able to use fiscal year 2023 if you can justify that you just don't have access to the data or there's not enough time to do the calculations. So I would expect the first year to have the most good faith understanding, but I'm not the state of California or CARB. And so I'll let Jay chime in if he wants to add anything to that.
Neither am I, though, Adam. I think that's a great start. Right. And we can cover a bit more detail in a few moments, but I think that covers the gist of that fiscal versus calendar year consideration. And
then Melissa says, should we report on the prior year's emissions? We won't have 2025 data by January 1. And let me clarify, a great question, Melissa. The climate risk report is not, you do not have to report your emissions. It is actually more like a materiality assessment for the broader sense of your scanning for risk and opportunities. But it is specifically on climate. And whereas which we'll talk about next with CSRD, for instance, out of Europe, you're scanning all environmental, social, governance issues around sustainability. That's a full materiality assessment, but this climate risk report is literally, TCFD is 4 categorical, non-prescriptive reporting categories, which are strategy, risk management, governance first, strategy, risk management, and metrics and targets, but you don't actually have to report your emissions. It certainly encourages you to, but you don't have to do a full 12 months of reporting. You just can describe your approach to how you're going to measure greenhouse gas emissions and what kind of targets and your approach to setting targets. But it is not the same as the SB 253 requirements, which is a 12 months organizational footprint of scope 1 and 2 emissions. So January 1st, saying all that, is just having conducted and published a climate risk report for your company. How does climate risk impact you financially, or could it in the short, medium, and long term? And those are traditionally broken into physical risks like flood, drought, major weather events, and or transitional risks, which we're looking at a transitional risk. It is specifically as society or governments or regulatory bodies change and more rules come into place, how is your company going to be affected? So those are 2 pieces of it. So just January 1 is a climate risk report. You don't have to have the data all measured, but June 30th, if you're a larger company, that's when you have to have the previous fiscal year's data actually measured and reported. And that's why they give you until June 30th, because they expect people to not even be able to collect that data until sometime in January. Great questions. Hold on. Another one, Sony, how does the legislation define, does business have a physical location? Shipping this to individuals in the state. Definitely doing business is something that I would just guide you to the CARB location, where you can sign up for their guidance, but it is based on California state law in the legislature, and they have some specific definitions. It does include physical locations, and I'm not a lawyer, so I would direct you to your legal department, and definitely I don't want to give legal advice, but it does match the California state law of doing business in the state. So I apologize for not having that clarification, but this is why I suggest signing up for their email on the California ARB site, because they are consistently getting these types of questions and coming out with additional guidance. Did you say companies generating $500 million to 1 billion are only required to comply with SB 261? Yes. If you are not at a billion, but you're above 500 million, you only have to comply with the climate risk reporting. Or did you mean to say that companies generate 500 million and greater need to comply with 261? No, for some reason, does not currently read as that the 1 billion companies have to do both. And there have been a lot of questions about that. And I've been on some webinars, and Jay, unless you have heard differently, it is once you are at the 1 billion, it's really about actually reporting your emissions. All right, thank you, Donna. Great questions. So now let's talk about CSRD, and I'll just kind of pause and pivot. Double materiality is something you might hear, and it's essentially just taking the investor approach, the financial materiality, and adding in something called impact materiality, which is your typical sustainability. How does your business impact society, people, and or the planet and the environment? And that's more sometimes of the feel-good stuff. And Andres Clem, thank you, put in C code section 23101 for doing business in California. Really appreciate that. So double materiality is that below the dotted line where we're going to talk about the CSRD, but others like China, CSDS, I believe India is now double materiality, but it's both. And so they expect a higher level of materiality assessment to include more risks and opportunities about your negative and positive impacts on society and the planet. And again, when you get these slides, you can download information and read this, what's happening with CSRD and the China CSDS standards. But it is an additional layer of both materiality assessment and reporting. Now, if we look at EU, it's really, because we're focused on North America here, I'm only going to focus on non-EU entities. And so there is obviously, if you're publicly traded, if you're large in Europe, this is going to apply to you, but we're focused here. If you're not there, but you have $40 million in revenue from the EU or $20 million, in euros, in assets in the EU, or if you're doing business in the EU and you have 250 plus employees that are located in the EU, then there's a threshold for you. And in 2026, what they recommend, that we recommend, because the dates have been pushed, so 2029 is when you're going to have to disclose your full double materiality assessment, the process you went through and the results of your double materiality assessment with limited assurance, as well as disclosing your 2028 material KPIs under that double materiality threshold, also with limited assurance. What we're recommending, because some people, rightfully so, there's a lot of things going on. Sometimes you feel like, oh, I'm just going to wait till 2029. We strongly recommend not doing that because it takes time and effort to put in a double materiality assessment. So we recommend you start there now, if you haven't, to get that initial data collection plan in place for whatever material KPIs you define. The double materiality assessment, just for reference, can take months, especially if you're going to do a full stakeholder engagement, which is where the real value comes in, I would say, for your specific company. And then you might find out, which most people do, you're not collecting data for the right KPIs, or the KPIs aren't defined in the appropriate way to address your stakeholders' concerns for those risks and opportunities. So doing a double materiality assessment now is great. It would set you up to then take the next step, which is get limited assurance of your double materiality assessment to confirm that your material topics do make sense and follow the CSRD's requirements of what a double materiality assessment looks like. Then you can have confidence and improve your data collection, and then get pre-assurance for those material KPIs to make sure that those are correct. And then by 2028, you'll be set up to have improved data collection. You know the material KPIs are accurate, and you'll have limited assurance already, and you will be confident that in 2029 you're going to meet the regulation, because there are penalties as well. They range quite broadly from France, 18,000 euros, to Germany up to 10 million. So there's quite a range, and it's something to really look at, but it's a very broad, much broader, but if you take the microcosm of greenhouse gas and climate change reporting of California, just increase that to all of your potential social and environmental KPIs. And that's what you have for CSRD, but it's also, you take the financial materiality for just California and broaden it to double materiality. So there's just an expanse and a broadening of the approach in multiple ways to get to the EU CSRD. So given that, has your organization, this is what you need to know for yourself, because it's only relevant or only material if it's relevant to your company. So have you attempted either a double materiality assessment or, just for greenhouse gas, a climate risk report in the past? Maybe yes, you've done both, which is SGS. But again, like we said, we're a very large global international company who's publicly traded. Maybe yes, but you've only done a climate risk report. Maybe yes, you've done the DMA only, and you didn't actually. If you do a double materiality assessment, it does not absolutely mean that you have done a climate risk report, because if for some reason you conducted a double materiality assessment and climate did not rise to the top of a long list, it is possible for you to either have not included it in a material topic, therefore you didn't do a full risk report on climate, and or you used the EU SRS and it's not comprehensive enough. You might not have dived in deep enough on climate and greenhouse gas emissions to actually meet the California rules and the TCFD, because they're not equivalent. You certainly could do a comprehensive double materiality assessment, and depending on who you worked with, it might meet the requirements of California and the TCFD and others, but it's not absolutely necessary. And then, or not absolutely given, and then, or no, neither. You've done neither one, or you don't know. Maybe you're not on that team and you need to go check it out and see for yourself. But hopefully that description helped of how they're not quite equivalent. They certainly could be. And then while everyone's answering, so Tio says, for companies already reporting to CDP or using TCFD, how much additional data is needed for California? If you CDP, two very different things. Good question. So CDP is a reporting platform. You could be reporting to CDP very poorly and not have much. It really depends on if you're meeting TCFD. If you're already meeting the TCFD standard, you essentially are going to meet the California climate risk standard, because you could just reference that, put your report in, but it has to be public, and you still have to put the link to where your public report exists on your website into the California ARB portal that opens on December 1st by January 1st. So great question. Now I'll jump. So we've got a very nice balance here. Yes, both. Climate risk, no, neither. So a nice group here. So definitely focus on what you need the most. And what I'm happy to talk about is just when you look at the pathway to approach these, hopefully you're seeing that there are similarities. CSRD is much broader than just climate and the California rules, but you should always start with training and a materiality assessment of some sort. The climate risk report, like I said, is a materiality assessment, but it's very specific to climate and greenhouse gas emissions, where a double materiality assessment for CSRD is very broad. The threshold for materiality is impact and financial materiality, and you're scanning all environmental, social, and governance KPIs. SGS, if you didn't know, we have something called SGS Academy. We offer tons of training, including specifically on greenhouse gas. You could even become a lead verifier if you want through our company, or just focus on like platform kind of technical workshops like CDP, which was mentioned, and then sustainability much broader on governance, execution, and reporting, or platform-wise, we do a course on EcoVadis. But we also have a ton of work done that we don't do as a third-party assurance provider. In most cases, we try to stay out of the consulting realm to avoid conflicts of interest. We do some help on EcoVadis and CDP ratings, but if you're going to do consulting, if you want to dive in with data management, you could use somebody like SGS. We can do the training, but you want to look at how do you manage that data and make it audit ready for that assurance, whether you're going to get limited or future. So I'm just going to hand it off to somebody we love to work with. We are neutral and independent, but I want to give it over to Gravity and show an example of how their tool works.
Thanks so much, Adam. Great to see everyone. Good morning, good afternoon. My name is Jay, and I lead policy and partnerships at Gravity. And I'm going to begin my section before diving in with just a couple of organizing questions and sort of themes that we hear pretty often, stepping back from all the great content and often, frankly, fairly daunting prospects of a lot of these regulatory or quasi-regulatory regimes a lot of our customers face. And so one basic one is just, look, with all of these assurance requirements and regulations raising the stakes around sustainability reporting, how do we ensure that our data practices can be audit ready at scale? And crucially, also in a way that doesn't require us, hopefully, to hire a whole new team and really break the bank for compliance. And the other question is sort of a related one, which is, okay, look, it sounds like we're going to be required to do a lot of this sustainability reporting now, but beyond the box ticking and compliance and fee avoidance and sort of reputation maintenance, is there anything in it for the business? Like, what might this actually mean from a value creation perspective? What might this mean for the CFO to care about the sustainability compliance work? And how do the pieces really fit together across measurement, data management, compliance for the rules and the regs, and the profit motive of the business? So these questions I'll try to address through a couple sections in our time together. Starting first with just a quick overview of who Gravity is, where we sit in the ecosystem, but then really spending the bulk of the time looking at three broad principles or kind of themes around the data management that undergirds companies reporting for these regulations and the assurance part of them. We'll do then a very quick kind of product teaser of a couple indicative features of kind of what this looks like in practice with technology. But then we'll wrap up by looking at a couple of real company success stories of how this is starting to look in the wild now that these regulations and rules are really here. So to start off, Gravity is a carbon and energy management software platform. So we're a software as a service company headquartered in San Francisco with offices in London and a team worldwide. And we call ourselves both carbon and energy management because we help companies with all things measurement of scope 1 to 3 carbon accounting, which, as Adam said, really is one of the kind of core nuclei within a lot of these major global regulations. Help them compile and do things like AI drafting of the broader sustainability reporting so that the audit can be really streamlined. We'll talk a lot about that. Supplier engagement, financed emissions. But I think also excitingly, we help companies start to translate that into value, understand, well, what does this mean from a potential emissions reduction perspective, also ideally cost reductive, where we can get those win-win scenarios, monitor projects, use energy engineering or other in-house talent, and actually get some progress done. We work across industries with hundreds of leading brands from construction to manufacturing, logistics, retail, CPG, financial services, really a broad range of companies. But we'll now get into these three principles of data management that I mentioned to kind of make this a little bit more real about how companies we think should actually approach preparing for the regulations that Adam has unspooled for us today. And the first one is to do with efficiency. So I think, as I mentioned at the top of the presentation, one of the core, first reactions we get from companies, even if they've never measured before or if they're kind of veteran sustainability disclosures, is that there's a lot of data involved. When you think about the scope 1 emissions, the emissions related to directly controlled or owned equipment, vehicles, heating that a company has, or scope 2 around purchased energy, electricity, before we even get to the scope 3 value chain question. There's a lot of data, there's a lot to consider about what of our operations are going to be relevant, how are we going to measure, what kind of data are we going to use, where does it live? And so data collection ends up being often one of the topics that has bedeviled sustainability teams for a long time, or whichever team has kind of had the hot potato of compliance thrown to them. And so historically, a lot of teams we've seen have had to read utility bills until their eyes glaze over, or fuel documents, or maybe shoehorn data into spreadsheet templates and spend all their time kind of scrubbing and cleaning things, unit conversions, all of that. And Fortunately, there's a lot of great technology out there that can use AI or other forms of automation technologies to really address the challenge of data collection here and boost efficiency, not just of the kind of actual calculation steps themselves, but I think crucially also upstream of that to do with data collection, data cleaning, et cetera. When you can connect directly into business systems too, that's always helpful with APIs, and we'll talk a little bit more about what that can actually look like. And just one kind of like heuristic or rule of thumb that we find helpful is that if you're spending a lot of time searching documents, reading them manually or adjusting, scrubbing data, spreadsheet templates, and there might be room for some efficiencies in the process. Great. Now to switch to the second broad principle here. And this really gets at, I think, a lot of where the puzzle pieces fit together between organizations like Gravity and those like SGS, where the rubber hits the road on assurance and rigor with these disclosures, is really to ensure every single data point in all of your disclosures has a very transparent history and provenance and paper trail to it. And again, a kind of rule of thumb here is that if you or maybe a neutral teammate on your internal audit team or otherwise can't follow a calculation to the source, both in terms of the actual business documents or actual business information that informed that data, but also the actual calculation approach and any potential omission factors or conversions happening, then your auditor might not be able to either. And that risks extending the audit, potentially increasing the cost of it, and just kind of adding some needless stress. And so we really recommend always trying to tap as much as you can into data at the source as upstream as you possibly can to minimize any manipulation and really just smooth out that transparent paper trail. A related point has to do with the calculation approach and the kind of methodology that'll be adopted in your disclosures. And this applies both to greenhouse gas calculations, but also just more broadly how you think about materiality, how you think about identifying risks and opportunities for the climate-related financial disclosure as part of SB 261, is consistency is really your friend. Often in this space, look, sustainability reporting hasn't been around forever. It's still decently new. A lot of companies are figuring this out. There often isn't a kind of gold star, North Star, right, in scare quotes answer that you need to be aiming for. It's much more about what is the process? Are you consistent in it? Is it well documented? Is it well thought through? Does it align with your business context and with the best practices and guidance, as well as, of course, the regulatory standards out there? And making sure all of that logic is really, and those policies are really consistent and easy to follow when it comes time to assurance from our friends at SGS or otherwise. The last kind of broad principle around preparing for regulatory disclosure that we'll talk about is kind of getting value from it. So I think, stepping back, a lot of companies, again, are kind of maybe resigned to the box ticking mindset here that, okay, we know that these are going to be big regulations that are going to require kind of the sustainability function to be more of a compliance one and a cost center in the company. And there's another piece of good news here, which is that for many companies, when it comes time to disclose on this data, all of the data that they've been collecting, things like utility information, fuel receipts, invoices, energy data, also financial data, GL accounts, operational data, production volumes, et cetera, all of that data is very similar to the data and often the exact same data you would need anyway to begin thinking about, okay, what's going to be the levers that are relevant for my company for potential emissions reduction, potential energy savings, being more efficient in our processes, depending on your industry. And so the good news is that there's really an opportunity to leverage this compliance exercise almost as a trigger for thinking about how can we be creating value for the company and orient the sustainability function, not just around compliance is important, but also in a way that directs that compliance to maximize the potential for business value. We'll talk about some real world examples again. I think that'll really bring these to life in a few moments, but I think it's also worth reflecting just on, again, the kind of novelty of a lot of these sustainability regulations. And we can take some analogies from the development of other kinds of compliance paradigms or regimes that companies now have to do that weren't around a long time ago, like cybersecurity or data practices or these other sorts of paradigms that maybe started out as more of a disclosure, box checking, compliance exercise, But companies soon found really sources of additional ways they could differentiate or find efficiencies across the business or otherwise. Great, so with that, I'm going to switch my screen and jump very quickly into the Gravity software platform for just a very quick kind of indicative tour of a couple of the features that we have within each of those pillars to make the compliance exercise not only more efficient, but also valuable. And maybe, or Adam or Kim, do you mind just a quick affirmation that you can now see my platform screen here?
I cannot see it.
I think we see something different. Summer, I don't know if you can see what the audience sees.
Yes.
We have a very different view.
How about now?
Now I've got it.
Yeah, it's good, Jay.
Okay, great.
Perfect.
Thanks so much. So again, a full demo would take a long time, and in the interest of time, we're really just going to focus on a very quick whistle-stop tour on a couple areas around data ingestion, transparency, and value. One thing to call out first before jumping into those is that one exercise that's very important kind of at the top of companies preparing for these rules is really getting a defined sense of what's going to be in scope for your own operations, what portion of your business from an organizational hierarchy and boundary setting question is going to be in play. And so defining that with tools like flexible organizational hierarchies and different fiscal or calendar year reporting periods is really helpful, and something that we've been intentional about, which then in turn corresponds to different features like data completeness and the audit trail that we'll get to. So we're really only going to zero in on one of the modules here at Gravity and not talk about kind of analyzing or reporting on or the actual reduction side of things. We're just going to focus on one site kind of as a lens into each of those themes I mentioned. So here on the measure page, this is where the scope 1 to 3 inventory and also ESG metrics and supply chain engagement happens. We're going to zero in on one of our sites here, in this case, the New York office. And I'll first talk about different ways of getting data into the platform, because as I mentioned, that efficiency around data collection, data ingestion often ends up being just such a chore for companies before you even get to the calculation stage. And so consequently, there's a lot of ways of getting data into the Gravity platform that we won't cover all of, but just as two quick examples, wherever we can integrate directly into business systems to pull in data, that's always the preference. And so, for instance, hooking up directly with utility providers to get whatever electricity, natural gas, wastewater meters pointed directly to the platform with the actual underlying source documentation is really helpful. Same with other ERP systems, travel systems, financial systems, et cetera. So that's always a great option. But the other one I'll show very quickly as well, because the reality is a lot of companies out there still have a lot of analog documents or, fuel receipts, utility bills, a lot of manual kind of paper lying around. So we've made it really easy to get from more unstructured data to actual finished calculations and audit-ready reporting. And to show just a quick example of that, I'll pull in here about a year's worth of electricity bills from my other screen. You may not be able to see it given the webinar platform, but I'll pull up an example in just a second. And Gravity's built a homegrown AI model that we call BillScan, which you could almost think of as a large document model that'll take about 20 or 30 seconds or so. And what it'll do is read those documents, interpret the meaning of them from a carbon accounting perspective. So it'll pull out, in this case, the kilowatt hours of electricity consumption, the unit, the start date, the end date, all the information you need to get to scope 1 and 2 calculations, in this case, scope 2 with electricity. And you'll start to see those processed automatically. You'll also see the site level version of that data completeness tracker start to tick upward and track at a very granular level the data that's being come in and the calculations that are being done. That's a good segue to the second theme around calculation transparency. Again, lots of other ways of getting data into the platform, whether it's messy spreadsheets or file transfers, et cetera. But I'll jump now into one of these data points to show you what that transparency looks like and how it plays a role in the assurance and the audit process. And I'll start at the most granular level of a single calculation and then kind of zoom out in abstraction from there. So you'll always see with every single calculation in the platform, essentially a transparent box of where did this information come from, what document was it pulled from, whether it's a utility bill, a fuel receipt, a spreadsheet, or otherwise a direct integration. All the great metadata and kind of event level history and audit information, if any changes were made for auditors to follow. Also information about what emission factor was ascribed, the breakdown in constituent gases and values of that factor, where it was pulled from, basically all the information, including unit conversions or inflation adjustment if needed, all the information that the auditors need to just very quickly do their core sampling so that they can see that the math pencils out and really just understand the calculation approach so that it can be trusted by your own team and again, crucially by the assurance in the assurance process. The same is true if you're doing estimates. So if you don't actually have that granular data, say maybe you just want to get a quick natural gas estimate here based on the building square footage or the type of building, we can do that math really quickly. And then crucially also, if I jump back to that particular data point around the estimate, you get additional contextual information for the audit around what was done, how, and what was the sourcing. So that's a quick view into kind of just the site or the calculation level understanding of transparency and auditability. The same principles then apply kind of moving up a level to this site as a whole, looking at the audit log of everything happening at the New York site or any additional methodological context that may be relevant for the data strategy or around estimation approaches or otherwise. And then as I start to round out the demo here, I'll zoom up one more level and show that, again, the same principles apply to the footprint as a whole in terms of methodology notes and inventory. And all of the great pivoting capabilities that, again, our auditor around getting actual value from this measurement process. So as much as we can, we try to embed more actionable insights, even directly into the measurement and reporting process itself. I'll just show one example of that. Most of that happens on the reduction page with more sophisticated target setting and project tracking views. But just as one quick example, if I go to a site here that's got a lot of electricity usage and is in a region of the world where a demand response program might be relevant for them, we'll already start to do the math to pre-qualify companies for, okay, what would be an indicative sense just based on the information we have so far of the impact of some of these initiatives, and very quickly connect you to our vendors and our financing partners in the region that are specific to you who can get these projects done very quickly. And so we always try to embed that much more proactive, value-driven approach in the process. So I'll go ahead and stop sharing, jump back into the presentation just for a few more moments as we start to round out here. And confirming, can everyone now see the slide deck again?
Yes.
Great, thanks, Adam. So we'll be sending these slides home and looking at the clock. I probably won't go through every detail of each of these slides, so please peruse them in your own time as takeaways. But we do have some real world examples here of companies who maybe started on more of that compliance end of the spectrum, really dialed in the efficiency and the transparency so they could get to more of the value step. And two examples here are companies who were new to carbon reporting and climate risk disclosure, Wisconsin Aluminum Foundry and Race Winning Brands, both of them large manufacturing companies that saw hundreds of thousands of dollars in operational savings and reduction in their exposure to the locally volatile energy markets through gravity implemented projects that were directly a result of that new granular access to data that they were able to get. One other one, I think another lesson that's helpful is just really, again, embedding that value creation into the measurement process itself. I think we see a lot of teams who, through no fault of their own, often have a measurement period of the year and then a reporting period of the year. And then all of a sudden it maybe is already time again for the measurement cycle again, and then reporting. And it kind of ends up being a compliance merry-go-round that gets hard to think about the strategic levers that could leverage that same data to make a business impact. And so Ovation, which is a real estate and construction company, did a great job of thinking through how can we actually embed much more of that value creation capture directly in the measurement process. And then last slide, a couple more examples of what does this look like at scale. So for a $10 billion GC, general contractor construction company in North America, and for TTI, 200 global locations, Berkshire Hathaway electronics distributor, how do you do this with hundreds of sites at scale and actually connect the measurement process to not only compliance, but getting value from it? So again, looking at the clock, I want to save a lot of our precious time for more Q&A and interactivity, knowing that you'll have these as takeaways. So I think with that, I'll go ahead and hand back over to the SGS team.
Thank you, Jay. I appreciate that. We'll just mention that SGS, as an independent third-party assurance provider, folks like Gravity do a bunch of the work in the middle. We often bookend with like training and then assurance or pre-assurance as well. We just really want to thank Gravity and Jay for being here and talk about, as this process and your pathway continues on towards assurance, you've done a ton of work. There is something called pre-assurance or often pre-verification. And that will pause for that step. That there is a benefit to that where you can save time and money. Often it's done 3 to 6 months in advance of an actual assurance engagement. It builds internal team confidence in your data. It really checks out just the definition and control, data management, things like that. There is no final data check in pre-assurance. That's why it's not a full assurance. We do not close findings. But it really looks at the process and the systems and the quality of your data and your approach. It does increase often the likelihood of assurance and helps you hit your publication deadlines. That's why people consider it. An example here is an electronics manufacturing client that we have. They had a verification within that same year, but they conducted 3 days of pre-verification about 6 months in advance. They received what ended up being like a findings log, but it's a report. And then we step away, and then they had the ability to go back and look at that really directly to the standard. Where was it not in line with what the standard would require? But then came back, 6 months later, and were able to do a full 5-day verification, in which you actually do close those findings and receive a statement of opinion. That leads up to the actual requirements of California and CSRD as examples, but limited sustainability report assurance or limited greenhouse gas verification. In this case with California, it's ISO 14064-1. That's we're an accredited firm, but actually greenhouse gas protocol is listed by name. They're very much in alignment. And if you followed the news, they're actually joining forces to completely align. And I don't know what they'll end up being if it's one standard, but they're the two out there. And greenhouse gas protocol, Jeff, you mentioned in a question I was going to get to, does SB 253 or CARB specify if only material categories are relevant for scope 3 disclosure? In greenhouse gas protocol, you do identify your material topics, but once you've been able to measure them, greenhouse gas protocol does ask that you still report. You certainly don't need to dive in and put a focus on primary data if you have immaterial topics, but if you follow the standard greenhouse gas protocol, that is what the regulation asks for. There are justification categories where you can say, this is irrelevant. We have this emission category does not exist for a company. But if it does exist and you're not reporting it, there must be a justification provided that meets greenhouse gas protocol as a standard. Good question. Now, the benefits of actual assurance or greenhouse gas verification in the case of California are very clear. There is internal confidence. Often you're making investments and putting business strategies together. You want to be confident that this data is accurate. There are final data checks, and you close all findings with your assurance provider. But a lot of the time it's driven by this external confidence from customers, stakeholders, investors. Again, it's third-party assurance, and often to meet regulatory requirements. And if you are subject to actual ESG ratings and some of these platforms, getting third-party assurance does increase your score in every occasion. Having third-party assurance is usually a layer of increased scoring. And then if you don't know what a public assurance statement looks like, it's often multifaceted. It will have all of the data that you're verifying, the standards you're verifying against, a complete scope of the engagement, what was in scope and out of scope, and then the resulting opinion. from someone like SGS, who's a third-party independent assurer. But that opinion is often at the limited level. It's called a negative opinion. We did not find anything to believe that the data reported was false. But if it's a reasonable assurance, you're talking about kind of CPA terms, but the reasonable level of assurance that investors expect for financial data, it's a positive opinion that we found data and evidence sufficient to believe that the data was true. It's a little, just go talk to your CPA friends, but it's all coming from the financial industry approach. But reasonable assurance is what all of these are sort of leading to. The difficulty, if you follow integrated reporting, which is, it's an interesting process, but reasonable assurance for financial data is very crystal clear. It's easy to understand what that means. But when you broaden it to sustainability reporting, greenhouse gas emissions have a fairly defined thresholds where the sampling is, sometimes if it's 5% of your total emissions from scope 1, 2, or 3 that we're going to be sampling that data down to source evidence, or if it's only limited, it could be a 10%. So there's different definable thresholds. But then if you look at every environmental KPI or every social KPI that you could possibly think of, that's where reasonable assurance kind of falls short today. Not every particular environmental topic or social topic has defined the measurement and the approach to data that fits with what reasonable assurance means and the definition of reasonable assurance. So that's why there are these multi-year timeframes that are trying to allow ESG or sustainability reporting to catch up with financial reporting, if it can be done. And that's why limited assurance is very, very common and probably the most common form of assurance out there when it comes to sustainability reporting today. That's it. We want to save a little bit of time, but now for you, what we offer is just think of what does your program need help with next? It could be some things everybody wants to do, but you have to plan on what's the most important. Is it really to get more training? Are you ready for a full materiality assessment? Do you need climate risk reporting? Are you ready at that data management stage where you need a tool to help you manage data that's going to be audit ready? Are you ready to do some assurance, maybe pre-assurance, or is just some other? And again, if you're going to put other, we recommend share it with us in the Q&A box. We'd love to hear. And as I do that, I see another question from Angelia. Hopefully I pronounced your name right. How do you audit the scope 2 emissions? Is it required to report both location-based and market-based? Greenhouse gas protocol, yes, does require both location and market-based. This is typically scope 2 is largely your electricity bills, but it can be other things like steam. It's purchased energy, where the energy was generated off-site, but then shipped or distributed to you. And location and market-based are both required under greenhouse gas protocol. How do we audit that? Very similarly, we look for your actual utility bills and your usage and consumption, and then we look at where you selected your emission factors from. Typically, one is based on broad things, like the most common is the EPA power profile tool. You can go look up just regionally. You can pull your emission factors from the EPA, or you will get a direct letter from the utility company that is generating, and they are supposed to be able to provide you. The vast majority of them are getting to this point where they can, but they actually need to provide you with a direct emission factor that they have calculated based on their actual production of energy. And so that's the two different versions. Is one is a regional sort of average, if you will, and the other one is specifically and directly from your utility company or your energy, your power plant. And give it a few more seconds if you haven't. I would say if we're in the other, we've done materiality assessment. We probably need to re-up as SGS. We need to re-up our materiality assessment on a regular basis and our climate risk reporting. Not that they haven't been done, but I would say maybe a B for us. And then a lot of folks need training. Definitely reach out to us. SGS Academy has plenty of that. Climate risk reporting, gravity. We didn't ask, Jay, does your tool, do you conduct climate risk reports, or do you only hold data and manage the data?
Yeah, great question. Both help companies across
perfect.
the full range of reporting.
Wonderful. So if you want to have that climate risk, assessment done, and then assurance, we are happy to hear from you if you need assurance, as well as pre-verification and pre-assurance. And then I'll just say, if you need free content on a ton of things, our YouTube channel at SGS North America is growing all the time. We put all of our webinar recordings up there. And there's more things, not just from our division, but across SGS. So please let us know. If you have other questions, drop them in the Q&A. I'll stick around for a little bit longer if we need to, but I just appreciate everyone's time. So if you do need to leave, no hard feelings. Diana says, have you seen any changes in how your clients approach sustainability reporting, considering the changes the OBBBA introduces, such as whether there has been any concerns or whether the focus is still strong to report on sustainability? So my question is the OBBBA, and I don't know what you're referring to, Diana. Yes, the comprehensive federal law passed recently. No, the concerns, like right now, there are certainly lots of things. I would expect there to be continued federal pushback on all kinds of things. We're only in the first year, but to that extent, nothing that's happened puts in danger yet any of like the California state law, and certainly not EU CSRD outside of the United States, or IFRS, which is the international accounting standards for the world. So no, that does not today impact anything we've talked about. But stay tuned. I'm not trying to predict the future of what could come next. Yasmin says we don't have a full grasp on what the SB 253 assurance requirements entail for June 26. What is actually required? How lenient do we expect CARB on assurance? So the assurance, limited assurance is the June 20th, 2026. It's only for scope 1 and scope 2. I would say you need to speak with an assurance provider soon. If you're not familiar with the steps, it's a kickoff meeting with your assurance provider. You share your data, and then based on the data that you provide us or any assurance provider, you will have to sample that data. And depending on the extent of your operations, there might be a site visit. That is a misconception that limited assurance doesn't require a site visit. There are more justifications that you can. There are ways to avoid it, but every standard, every assurance standard does have an expectation that you at least do a strategic review of your data and a risk assessment. If you're, for instance, a small one-room office or something, there's absolutely a yes, you can do it remotely. The more digital kind of data management you have, but it is a professional judgment that has to be taken based on the standard that you use to assure. And you do need to do an audit of the data, get a list of findings, and then close all those findings so you don't have any non-conformances. There's a technical review then by another technical reviewer who's qualified within that same assurance body, and then you get issued a statement. So it's something to plan ahead for. Find your assurance provider early. And the leniency is not on assurance. The assurance is the least lenient part because it's a highly specific, highly defined, accredited type of service that is very well managed. And the leniency is just get it, plan ahead. If it's not done, that you would definitely be looking at the possible penalties from CARB. How much does third-party assurance cost? The thing with greenhouse gas is that it is very much, there's a wide variety. I'll give you some window of, you should plan for no less than maybe around $10,000, but the larger and more complex your organization is, the more regions you are in, the heavier industrial categories that you are in, it just climbs from there because it is a sampling exercise. And there's no good way to say it except for that there is a detailed questionnaire that you'll receive that asks for all of the factors, and that you will get a very clear scope in a proposal that is based on your company specifically. Anissa, do you need to be a verification body or just have certification to provide assurance? You do need to be, you have to have an accredited, you have to be an accredited service provider and a verifier to meet the CARB standards today. Whether that changes and they find that there's a limit, but you do have to be an approved verifier. Verification body, there's the term, it's just, you have to be approved as a verifier under either CARB or ANAB is popular in Canada. They have there's different accreditation bodies. As long as you're accredited and approved, they will accept it today. If there is some sort of volume concern, CARB may offer clarification, but they have not yet done that. All right. Any other great questions? I would say we ran over because we had great questions today, but if there's anybody else, I would just say we can send those questions on to the speakers because it's 11:06, but thank you everyone. And thank you, Jay. Thank you, Kim. Thank you, Summer.
Thanks all for your time. And thanks, Jay and Adam, for all of this wonderful information. Hope everyone has a great day.